There's been a lot of news about inflation, all of it associated with the idea of what's going on, how can inflation be so high? For Stephen and I, as we think about next year, as we think about portfolios, the question of it's being transitory or not is incredibly important.
Financial markets across the board believe that we don't have a very severe long-term inflation problem. They do believe that we have a short-term inflation problem. We still think that that's really the right view.
The bond market already is anticipating 4 to 5 rate hikes by the end of 2023. Now, what's interesting about that is it sort of says that the bond market does not believe inflation is going to be a long-term concern. But it is also telling us, and I think this is important as investors, that if you hold cash, you're going to have that cash diminish in value for the entirety of the next decade. And that's a major problem for us when we're building portfolios.
A lot of people are asking me about inflation hedges and what we should do about it. One of the things that we could do, which is fairly obvious, is own the real economy. Central banks don't print oil, they don't print real estate, they don't even hire teams of software engineers, they print money. And so equities, again, are in one way an inflation hedge.
We are still overweight equities, which I think going into next year is exactly the right thing for us to do. We're overweight by 6%, but we have modified briefly our mix of equities. This is precisely the time when you want to get out of the way of the cyclical readjustment that's going to occur in areas like digital communications, or in the case of certain home exercise equipment makers. You want to identify industries that now can continue to grow and grow profitably.
Think about companies that either grow relative to the size of the economy. You have to be in the right industry and you're ideally the right company. And chances are, if they're part of the migration of physical to digital, whether that is fintech, whether that is cybersecurity, whether that's e-commerce, the economy is becoming digital, right? So that's gaining share of the economy overall. Then you can find companies that are leading within that industry, but we don't want to swerve completely away from growth. We want to have balance between growth and value, growth and income in portfolios now. The firms that are the best long-term consistent dividend growers, the largest single sector in the US market is a staple sector. If you take a look at the steady grower of healthcare, again, beneath the surface, and you'll be able to read in our outlook and take a look at the demographics that are driving this globally. This is the kind of outperformer for the long run that we want in portfolios.
You can see that these are two of our stock selections for next year that give us confidence that we can create alpha between a combination of increasing earnings, increasing dividends, and the potential, of course, for companies to restructure their balance sheets to buybacks. We're focusing on areas of dividend growth, of quality, of market leadership, and of industries that are either going to change back to normal, which is consumer staples, or continue to have relatively outstanding rates of growth.